Imagine a company so large that it appears inside Apple, Microsoft, Amazon, Nvidia, Coca-Cola, and thousands of other corporations at the same time. A company connected to more money than the economies of most countries on Earth. A company most people have never visited, yet millions indirectly trust it with their retirement savings. That company is called BlackRock. And once you understand how it became so powerful, you may never look at modern finance the same way again. Today, BlackRock manages roughly $14 trillion in assets. That's not its own money. That's money belonging to pension funds, governments, retirement accounts, institutions, and ordinary investors. Still, the number is almost impossible to imagine. If BlackRock were a country, it would rank among the world's largest economic powers. But here's where the story gets strange. Millions of people online believe BlackRock owns everything. Some claim it controls the stock market. Others say it controls housing. Some even call it the most powerful company on Earth. At first, those claims sound ridiculous. Then you start looking at the numbers. BlackRock's ETF division, iShares, manages around $5.5 trillion. Its Aladdin technology platform helps institutions monitor roughly $25 trillion in assets. Suddenly, the conspiracy theories don't seem to come from nowhere. The real question becomes, how did one company get connected to so much of the world's money? And the most shocking part? This story didn't begin with success. It began with failure. A mistake so expensive that it could have destroyed a career. A mistake that pushed one Wall Street trader to rethink how money, risk, and power really work. That trader was Larry Fink. Long before he became one of the most influential people in finance, he was simply another ambitious banker trying to climb Wall Street. Everything seemed perfect until one trade went horribly wrong. In the 1980s, Fink was considered one of Wall Street's brightest rising stars. Then a major interest rate bet reportedly contributed to losses of around $100 million for his employer. On Wall Street, losses like that can end careers overnight. Most people would spend years trying to recover their reputation. Instead, Fink became obsessed with a different question. Why do smart people make catastrophic financial mistakes? Was it greed, bad information, or was the financial system itself blind to risk? That question would eventually create BlackRock, not through secret meetings, not through political connections, but through an obsession with understanding risk better than anyone else. Ironically, the company accused of controlling everything was originally built to solve a problem most investors barely noticed. In 1988, Larry Fink and several partners launched BlackRock. Back then, nobody imagined it would become the world's largest asset manager. It wasn't famous. It wasn't powerful. It wasn't even particularly interesting. It was just another financial startup trying to survive. But while competitors focused on making money, BlackRock focused on understanding danger. What happens if markets crash? What happens if interest rates change? What happens if the unexpected happens? Those questions would eventually make BlackRock one of the most trusted firms during financial crises. And that trust would become priceless. Because 20 years later, the global financial system would suffer one of the biggest disasters in modern history. While giant banks were collapsing, BlackRock was about to receive an opportunity that would change its future forever. When most people hear that BlackRock manages around $14 trillion, they imagine a company buying businesses one by one until it owns the world. But that's not what happened. The real story is much stranger. BlackRock's rise came from a financial product so simple that millions of ordinary people use it without even realizing it. And that product would eventually place BlackRock inside thousands of companies at the same time. Imagine you have $100. You could put it all into a single company and hope it succeeds. But what if that company fails? Now imagine putting that money into a basket containing hundreds of companies. If one struggles, the others can help balance the loss. That simple idea became one of the biggest revolutions in investing. The financial version of that basket is called an ETF, or exchange-traded fund. Instead of buying one stock, investors buy a fund that owns many stocks. For ordinary people, ETFs made investing easier, cheaper, and less risky. For BlackRock, ETFs would become the foundation of an empire. In 2009, BlackRock acquired Barclays Global Investors. Hidden inside that deal was a business called iShares. At the time, many people saw it as a smart acquisition. Few realized it would become one of the most important purchases in financial history. Over the next decade, ETFs exploded in popularity. As millions of investors poured money into ETFs, iShares kept growing. Today, iShares manages roughly $5.5 trillion and remains one of the largest ETF businesses on Earth. Every new dollar invested made BlackRock appear appear inside more companies across the global economy. Now imagine a teacher in Texas buying an ETF for retirement, a nurse in Canada buying an ETF, a factory worker in Germany buying an ETF. Their money enters a fund. That fund buys shares in companies like Apple, Microsoft, Amazon, and Nvidia. Suddenly, BlackRock appears as a major shareholder across corporate America. This is where the internet starts getting confused. People search shareholder records and see the same name again and again. BlackRock owns part of Apple. BlackRock owns part of Microsoft. BlackRock owns part of Amazon. After seeing the name thousands of times, many people reach a dramatic conclusion. BlackRock owns everything, but ownership and management are not the same thing. If a bank holds your savings account, the bank doesn't own your money. If a lawyer manages an estate, the lawyer doesn't own the estate. Similarly, most of the assets BlackRock manages belong to clients, not BlackRock itself. Yet, even after understanding that, another mystery remains. If BlackRock doesn't own most of these assets, why do politicians, CEOs, and regulators pay so much attention to it? Why does a company that mainly manages money receive so much influence? The answer is voting power. Public companies regularly hold votes on executive pay, board members, mergers, and major corporate decisions. Because BlackRock manages enormous pools of shares, it often votes on behalf of clients. That doesn't mean it controls companies, but it does mean its voice is difficult to ignore. As BlackRock grew, it wasn't alone. Other giants like Vanguard and State Street were also expanding. Together, these firms became some of the largest shareholders in many major corporations. Critics began asking whether too much financial influence was becoming concentrated in too few hands. Meanwhile, BlackRock was building another advantage, something far less visible than ETFs, something most ordinary investors had never heard of, a technology system that would eventually connect to roughly $25 trillion worth of assets across the financial world. Its name was Aladdin. And when the biggest financial crisis in a generation arrived, that system would help transform BlackRock from a successful investment company into one of the most influential organizations in modern finance. By 2007, the global economy looked unstoppable. Banks were lending aggressively. House prices kept rising. Investors believed the good times would continue forever. But hidden beneath the surface was a mountain of risky mortgages. Few people understood how dangerous the situation had become. And when reality finally arrived, it hit harder than almost anyone imagined. At first, the warning signs were small. More homeowners began missing mortgage payments. Then losses started spreading through banks and investment firms. Suddenly, financial products that had once seemed safe were losing value at an alarming speed. Confidence disappeared. Fear took its place. In March 2008, one of Wall Street's most respected firms, Bear Stearns, nearly collapsed. Founded in 1923, it had survived wars, recessions, and market crashes. Yet within days, the company found itself fighting for survival. Investors were shocked. If Bear Stearns could fail, who would be next? The U.S. Federal Reserve and J.P. Morgan Chase stepped in to prevent a complete disaster. But there was a problem. Someone needed to evaluate and manage billions of dollars of troubled assets tied to the rescue. That responsibility helped bring BlackRock into the center of the crisis. Then came September 2008, a date many economists still consider one of the most important moments in modern financial history. Lehman Brothers collapsed. Markets panicked. Investors rushed to sell. Around the world, people watched retirement accounts and investments lose enormous value in a matter of weeks. The crisis wasn't just hurting banks. It was threatening the entire financial system. Businesses struggled to get loans. Consumers stopped spending. Governments feared a chain reaction that could trigger an even deeper economic collapse. Then another giant entered trouble. AIG, one of the largest insurance companies in the world. The company had enormous exposure to mortgage-related products. As losses mounted, officials worried that an AIG collapse could create even more chaos throughout global markets. During this period, BlackRock was selected for multiple advisory and asset management assignments connected to crisis-era programs. The reason was simple. While many firms were trying to survive, BlackRock had spent years building expertise in understanding complex financial risks. That expertise suddenly became incredibly valuable, and at the center of that expertise was a technology platform called Aladdin. Most ordinary people had never heard of it, yet many of the world's largest financial institutions relied on it to monitor risk, stress test portfolios, and understand what could happen during extreme market conditions. Think of Aladdin like an air traffic control system for money. It doesn't own own the planes. It doesn't own the passengers, but it helps institutions understand where risks exist before disaster strikes. Over time, the platform became one of BlackRock's biggest competitive advantages. Today, assets connected to Aladdin's risk management ecosystem are often estimated at around $25 trillion. That doesn't mean BlackRock owns that money. It means institutions around the world rely on BlackRock's technology to help monitor and analyze it. The crisis also created an opportunity. Investors became obsessed with risk management. Pension funds wanted more transparency. Governments wanted better oversight. Financial institutions wanted tools that could help them avoid another disaster. BlackRock happened to offer exactly what the markets suddenly needed. Then, just as the financial world was recovering, BlackRock made one of the most important acquisitions in its history, a deal that would transform it from a powerful asset manager into the largest asset manager on Earth. And that deal centered around a business called iShares. In 2009, while much of the financial world was still recovering from the crisis, BlackRock made one of the most important acquisitions in its history. The company purchased Barclays Global Investors for approximately $13.5 billion. Hidden inside that deal was a business called iShares. At the time, few people realized this acquisition would help transform BlackRock into the largest asset manager on Earth. The timing was perfect. After the financial crisis, investors became more cautious. Instead of trying to beat the market, millions began looking for simple, low-cost investments. ETFs fit that need perfectly. And because iShares was already a leader in ETFs, money started flowing into BlackRock at an extraordinary rate. Year after year, the numbers grew larger. Pension funds invested, retirement accounts invested, governments invested. By the end of 2025, BlackRock managed a record $14.04 trillion, attracting roughly $698 billion of net inflows during the year alone. Those numbers helped cement its position as the world's largest asset manager. Then came the controversy that exploded across social media. Millions of people started hearing the same claim. BlackRock is buying all the houses. Videos collected millions of views. Comment sections filled with anger. Many people genuinely believed BlackRock was purchasing entire neighborhoods and making homeownership impossible. The reality was more complicated. Much of the internet was confusing BlackRock with Blackstone. The names sound similar, and both operate in finance, but Blackstone became far more associated with large-scale real estate ownership and rental housing investments. BlackRock's primary business remained asset management, ETFs, pensions, and investment products. That doesn't mean housing problems are imaginary. Home prices have increased dramatically in many cities. Institutional investors have purchased homes in certain markets. But reducing an entire housing crisis to one company ignores factors such as housing supply, interest rates, construction costs, zoning restrictions, and population growth. Ironically, the housing controversy revealed something fascinating. BlackRock had become so famous that people began connecting it to almost every major economic problem. Whether the issue was housing, inflation, stock markets, or retirement savings, BlackRock's name seemed to appear everywhere. Then another battle started. This time it involved three letters that divided politicians, investors, and businesses around the world. ESG, environmental, social, and governance investing. Supporters argued ESG helps investors understand long-term risks such as climate change, regulatory pressure, and corporate governance failures. Critics argued investment firms should focus only on financial returns and avoid influencing social or political issues. BlackRock found itself trapped in the middle. Some activists accused the company of not doing enough on climate issues. Others accused it of doing far too much. Somehow, BlackRock became a target from both sides of the debate at the same time. The backlash became especially visible in Texas. State officials challenged BlackRock's ESG-related approach, arguing that some policies could harm energy companies. In 2024, the Texas Permanent School Fund ended approximately $8.5 billion of investment management contracts with BlackRock, turning the dispute into a national story. And that brings us back to the biggest question in this documentary. Does BlackRock actually own everything? The answer is no. Most of the trillions associated with BlackRock belong to clients, pension funds, governments, retirement accounts, institutions, individual investors. BlackRock manages those assets. It does not personally own most of them, but that doesn't mean BlackRock lacks influence. Through ETFs, proxy voting, investment research, Aladdin technology, and relationships with major institutions, BlackRock sits near the center of modern finance. It doesn't need to own everything to have enormous influence. In some ways, being connected to everything can be just as powerful. Larry Fink's journey began with a devastating mistake. That mistake led to a company built around understanding risk. Decades later, that company manages around $14 trillion, influences conversations across global markets, and remains one of the most powerful financial organizations in history. So here's the question. When a company becomes connected to so much of the world's money, does it matter whether it owns everything, or is influence alone enough to change the world?